just cut rates again, and this holiday season might be the best real estate window we've seen in years. Here's what smart buyers and investors need to know right now. Keys with Kowal, your PNW real estate and mortgage guide. Here's how the Fed's latest 0.25% rate cut is shaking up real estate heading into the holidays. On October 29th, the Federal Reserve lowered rates for the second time in a row, and it's stacking on top of already falling mortgage rates. Even with the government shutdown limiting economic data, one huge metric came through. Inflation rose only 3% in September, which was below expectations. That gave the Fed room to cut, and now buyers and investors have an earlier than expected holiday opportunity. Mortgage rates are already trending down. Throughout 2025, we've seen consistent downward movement. 30-year mortgages are now in the low 6% range. 10, 15, and 20-year mortgages sit in the high fives. It's nearly a full percentage point shift from the 7% plus rates we saw at the start of the year. Freddie Mac even noted that refinances now make up over half of all mortgage activity. What Fed rate cuts actually mean? Rate cuts impact short-term borrowing most, things like credit cards, but they also influence the overall rate environment, which supports lower mortgage rates over time. Adjustable rate mortgages and HELOCs are tied more directly to the Fed's moves, so they'll adjust even faster. What this means for homebuyers? Buyer confidence is up, the highest it's been in 6 months according to the NAHB. But many buyers with 3% and 4% mortgages are still staying put. A CNBC survey found that 49% of people think it's becoming a buyer's market, but affordability concerns remain. A lot of buyers are still waiting for more cuts, which many predict are still coming. What this means for real estate investors? Investors play a different game. Waiting too long often means missing the window. When rates fall, prices typically rise, equity grows, refinancing becomes more powerful. Buying early while riding rates down is one of the strongest equity building strategies available. Refinancing at the bottom lets investors pull cash for repairs, future deals, or improved cash flow. Look for emerging markets. Winners will be the markets with high job growth, housing demand, business and infrastructure investment. These markets support stronger rents and stronger returns. Pre-construction opportunities. New builds and pre-sale projects can be huge plays during dropping rate cycles. Developers often offer early buyer discounts, upgrade incentives, below market introductory pricing, and if you decide not to sell, they still rent extremely well in hot markets. Smart plays for mom and pop investors. Rates aren't falling back to 2021 levels, so protecting the downside is key. That means looking at more affordable markets where you can still cover payments even if rents dip. Investor activity in states like Missouri, Oklahoma, Kansas, Utah, and Georgia led the nation last year, while tourist markets like Maine, Montana, Alaska, and Hawaii saw extremely high investor ownership. Combining long-term tenants with the occasional vacation rental boost can create a strong, balanced portfolio. Final thoughts. Even with a rate cut and another expected one in December, cash flow still depends on purchase price, mortgage rate, rents, taxes and insurance, and repair costs. It's all interconnected. Rates alone won't create instant cash flow, but the current environment is one of the best buying climates we've seen in years. If you buy right, avoid over leveraging, and pick a market on the rise, this could be the moment that sets up your next big move. Keys with Cole, your Pacific Northwest real estate and wholesale lending partner. Thinking about buying, refinancing, or investing? Book a time with me at linktr.ee/keys with Cole. That's Kowal. I look forward to the next conversation. Have a great day. Be sure to like and subscribe.